Hello students, welcome to SFM sessions. The topic what we'll discuss in this session is portfolio management. Let me just start and give you how does the concept of portfolio management work. Whenever you must have heard this word portfolio n number of times, I'm sure of that. Whenever you use the word portfolio, we are more interested in understanding what does the portfolio mean, right? Use the word and don't know the term, that could be something disgraceful, right? So portfolio basically from investments perspective means a combination, a combination, a combinations of securities, yeah, investments where the investor has parked his money in order with an intention to earn some returns. I repeat myself. Portfolio primarily is a combination where the investor has parked his wealth in order with an intention to earn some returns. Okay, so the question stands, so where can you invest? That's not difficult to answer, right? Where can you invest? The first most interesting answer could be bonds or risk-free asset. In general paradigm, we can just call them as FD, fixed deposits. The most common investments. India, as far as our country is concerned, most of the money is in FD. Equity markets have still got a lot more exposure. This gives our second answer, equity markets. Interesting to know, right? Equity markets, risk, returns, Reliance, TCS. Uh, this is a huge market, right? Or we can invest into a portfolio itself, which is managed by some other people. That's called as an investment into mutual funds. Mutual funds. So it's like I am creating my portfolio, where my portfolio is into another portfolio managed by different people. All right. Next one. Other than that, it could be real estate. Very stable investment. Real estate. Right? So on your part, many more assets, art, architecture, land, there could be plenty, insurance, PPF, there could be plenty of investment possible. The intention stands always that you have parked your money as an intention to earn some returns. That's the bottom line. Right? Now over here, we are first interested to know. We are not learning what is portfolio. That's a simple start actually. What we are learning is how to manage a portfolio. That's a serious question. How to manage a portfolio. Why? Because if you become a mutual funds fund manager or you are handling your own money, you are basically handling something which is very, very volatile. Very, very volatile. And what is that? That's money. Somebody's hard-earned money is in your hands to manage. Right? Most of the people who invest into the markets, or let's say invest into the mutual fund industry, are not having their prime business as investments. Everybody is not Rakesh Jhunjhunwala, right? Everybody does not have its primary business to invest into markets. They have a separate job, they have a separate life, they have a 9 to 5 job, or maybe 9 to 9 job, where they earn, they save, and from that saving, a fractional amount is invested. You do not want to disappoint them. Why? Idea is simple. Your client gets disappointed, your returns, your money, your earnings gets hampered. Right? So the question stands over here that, sir, when you are handling investments, when you're handling mutual funds, or when you're handling a portfolio, you have to take utmost care. Take utmost care. Right? What is portfolio management? Is all about calculations. It's about taking care about the client's investments, client's portfolio. Where to invest? What is the risk appetite of my client? Come on. What is the come on? If I speak to a guy aged 22, let's say Mr. Ajay, aged 22, let's say a young chartered accountant like you, possibly after 1 year, one attempt, right? So a guy named Ajay, he's a chartered accountant and he's thinking of investments. stable income, right? So let's say he is having a stable, he is having a good corporate job, he has a flat of his own. Now, what would you suggest him to invest into FDs, or would you like him to invest into markets? Right? Answer is yours. If I am his portfolio manager, my answer is go for equity. Take risk. You are young, energetic, you can take risk. And same goes if there is a guy, let's say named Sanjay, aged 58, right? Maybe uh, maybe a businessman, yeah, maybe a job guy, a person who is working from 9 to 5. Everything is fine. The question is, at such an age, maybe he won't be able to take that much risk. He won't be able to invest into equity markets. Argument why? It may sound weird, but the volatility in the market can't be handled by this guy. Not to the extent Mr. Ajay can handle. Those are personal biases, but age factor, keeping the judgmental attached. Another question, sir. The first thing, if you remember, the first thing, those who have watched CNBC, you must have watched, right? You must have seen CNBC channels. Whenever an investor calls an analyst, the first question the analyst asks him is, what is your holding period? What is your holding period? So are you investing for 3 months? Are you just flowing with the tide? Maybe you are just into the news about the market that everybody is bullish. Maybe you are just taking on the scope of the latest budget. Maybe you are just into the scope of taking an advantage of the latest news of people's desirable government. You're just invested into 3 4 months. Now, in that circumstances, your holding period stands very slow. 3 6, probably very very low. But if you believe into long-term growth story, when I use the word long-term growth story, idea is, what is long-term? Undefined. I'm not teaching you taxation where 36 months counts. We're talking about long-term. Long-term simply means where you give the company a chance to perform. You give the company a chance to perform. Like Wipro, we believe in the historical growth stories of Wipro. The company which has made billions and has created millionaires. Right? So over here, you believe in the long-term growth story of the company. You are staying for long-term into the company. Do you believe in the prospects of the country, like BRIC nations, Brazil, Russia, India, China, South Africa? Do you believe in the long-term growth story of these nations? If you do, you stay invested. You're least bothered about the lows and the downs of macro variables. This is all about portfolio management. How do you manage the risk? Again, the new question counts. We should always know your client. Now, of course, you may say KYC. Yeah, you may say KYC, not an issue. You can say KYC. But the question is, you should always know your client. If I do not know my client and I sell him a product, maybe I lose a customer for him. The question is, what is the risk appetite of my client? You may wonder, what do you mean by that? Maybe he's a risk seeker. Maybe he is risk averse. You may wonder, what is this? A risk seeker. Maybe he can handle risk. Maybe he loves risk. So you can put his money into small cap sectors, mid cap sectors where he can enjoy loads of wealth. But something bad happens, the returns could be down. You should be able to handle that. Right? In case of risk averse, these guys tend to stay a bit away from the risk and are willing to take slight risk if you offer them slight risk premium. Right? Risk averse, I dislike risk. Risk seeker, I kind of love risk. Right? So the question is, I got to know my client. According to my client features, I will decide the company, the sector, or probably even the country in which he wants to invest. Depends on the worth of my client, the HNIs or portfolio created, some kind of grows or something like that. Again, the question is, my client could be a risk seeker, my client could be a risk averse. The term risk will play a major role. Term risk will play a major. We'll come back to this point soon. Again, another question starts. Another question. Once we know his risk appetite and we select the company, a sector, a country, we follow one of the two approaches. It could be a top-down approach or a bottom-up approach. One of the ways of analyzing, basically top-down or bottom-up. You can just go for the word EIC. You may wonder, what is EIC, sir? EIC could be the economy analysis, industry analysis, and company analysis. Actually, I've written the same thing now. Economy analysis, industry analysis, and companies analysis. Come on, if you believe in the long-term growth story of China or India, the emerging markets, so-called emerging markets, you're invested, you're staying invested into the country for long term, say around 10 years, say around 15 years. And you will look at the magic of the market, your money gets multiplied like historical growth rate says in India, the equity markets has shown a growth rate of more than 18%, compounded. Mark that, compounded. It's a big number, isn't it? So over here, we can go for a top-down approach where it could be economy analysis. I'll just analyze the country, whether there are growth prospects in the country. I'll analyze the industry, like maybe IT industry, maybe pharma industry, right? Both are booming industries, like IT industry. TCS is the next big thing all over, right? Pharma, maybe Glaxo, Sun Pharma and Baxi. Economy analysis, industry analysis, and then I can get into company analysis. Let's say, for example, I select IT, I may get into TCS, I may get into Wipro, or maybe I can get into some mid-cap company like Cognizant or something odd. Right? So over here, what we learn is we focused on economy, sector, and then the company. It's all about top-down. If we talk about bottom-up, the bottom-up exactly reverse. It's about company, about sector, industry, and then you focus on the country. I can give you a very, very easy example. Take FMCG as a base. HUL, Hindustan Unilever. ITC as your base. Question stands. Guys, with a country with a population of more than 125 crores, FMCG company has nothing to worry. Utility companies, nothing to worry. Why? Idea is simple. The demand supply is very, very comfortable for these companies to perform. So if I just want to stay in calm waters, I don't want to take more of risk, I can simply put my money in HUL, maybe Asian Paints. So the question is, if I believe that the company is a strong company with a very strong fundamentals, having a great business, I don't have to worry about the economy. I don't have to believe in the macro variables. I'm more concerned about the company. That's why the secondary and the tertiary preference is given to country as well as industry. I hope it is clear. Right? These are some small, some petty points, some important eras where you need to focus, where you need to understand your client so that you can just create his portfolio, you can manage his portfolio. Once you have done all these analysis, just give me a second. Once you have done all these analysis, the next task, I repeat, the next task is to construct a portfolio and evaluate a portfolio. It's like we have learned how to plan a portfolio. All this was about planning. The second is you need to implement what you have planned. You have to implement, of course. What do I earn if I just make a plan on papers? I need to invest it, right? I have to implement it. So I plan, I implement. I construct a portfolio, right? While implementing, I could have various strategies. I could have a strategy like a very old strategy, buy and hold. I could have a very popular strategy, momentum. Or I could have a constant proportion portfolio investment strategies. The question, what's buy and hold? Buy and hold is very simple. Buy and hold is it's buy an asset, buy a share, keep it for long term. The best example I have for you for buy and hold strategy, guess what? 10,000, a mere 10,000 rupees invested into Wipro in 1980s. Its today's worth is approximately 650 crores. It's like 35 years, 10,000 becomes 600 crores. You decide. buy and hold strategy. You buy, you believe in the company, and you hold the asset for real long term. Real long term. 20 years, 25, 30. Maybe they buy for retirement. They are genuine people who are interested in dividend incomes and who are believing the long term growth story of the company. Momentum investors. Go with the wind. Buy the stocks which are rising. Sell the stocks which are momentum. Go with the wind. Do what the market does and do what the market is doing, and you'll make money. Momentum investing. CPPI, constant proportion portfolio. In this case, in this particular CPPI case, we uh, you know allocate our money into bond, that is risk-free asset, and equity market in a particular proportion to ensure that my portfolio does not fall below a particular amount. This is very good advice given by mutual fund managers, where they give a planning kind of the capital would not erode. So different ways of implementations. Right? So first we learn planning, then we will go into deep. Then we learn planning, then we learn implement, and the last and the most important is the review. We need to compare our portfolio's performances with the benchmarks and just create a result that whether we were able to match, whether we were outsmart the market, whether we were beaten by the market, and what happened. I mean, where was a mistake, right? This is all entirely your portfolio management. A real fun area. People generate income, people generate wealth out of stocks. I hope you enjoyed the session. See you in the next sessions. Bye bye. God bless.